Hello everyone. Today is April 7th, and this is our final session with Corey Rosenblum, I'm sorry, Corey, on practical technical analysis. Corey, welcome back, and I personally can't wait to go through this final piece because this is where you're discussing a lot of your kind of like trading tactics, trading entries, specific entries. So is that what you're going to cover today for us?
Absolutely. It's good to be back with you all, Ramon. Thanks for having me. Thanks for being with me this afternoon. Exactly. So we were talking before the broadcast started that it was really neat putting this together in a formal presentation from principles to setting up what the market's structure, how they move, what the foundations are, and of course setting the trade setups, your flags, your head and shoulders, things you've probably heard of, triangles. But then we're going to do what we're doing now is keep with our modeling. We kind of finished last week with that as well. We trade model out flags, trade model out a couple of breakouts. I'm going to pick that up with some fades and other things too, but we're just modeling out these types of setups, and that's it. I mean, theory is one thing, but execution, putting it to work and managing our trade, putting our stops or targets and doing all those things, really that's how you make money. It's not just, oh, look, I saw the market going up. It's you got to put your money on the risk and take your stops and put your targets. So that's what we're finishing up today, and there's, of course, a summary at the end. But practical TA, that's exactly what we're doing. So go ahead, sorry, go ahead, Ramon.
Yeah, okay. Yeah, I think that we are ready. Let's go for it.
Oh, okay.
Yeah.
Oh, right. Well, cool. Well, thank you all for
I
joining. I
think
apologize.
it's Friday, so that's why.
That's right. You're like, I'm excited for the weekend. Yeah, I sincerely apologize for last week. I've been in Los Angeles for about 4 years now,
Hmm.
and the power grid's perfect, but that just wound up being a neighborhood-wide power outage. Like a transformer blew that took out the power for the whole neighborhood. So that was something we couldn't really have avoided there. So I've been doing these presentations for about 10 years. That's the first time I've had to cancel a presentation because of power. So that was highly embarrassing, but something that was totally out of our control. But thank you for your patience and for being back. And so with that being said, let's jump into this. And so, of course, all trading does involve risk. And again, thank you for the emails. Thank you for the other comments. We'll keep it still conversational. And for the final piece of the puzzle, the final slides presentation, the fifth class, and type in your chat box, the question box, anything you want to ask the presentation, and time permitting, I bet there'll be time, but we'll see. We'll take a look at the current market and put these things to work randomly. So give me a stock, give me a market, give me an ETF, and we'll just put it to work. So I've selected a couple things for you, but I think it's more fun if we just start the final discussion at the end of it by just doing that. So think about that as you get toward the end of the presentation. We're going to use some real world examples, probably talk about Amazon. It's been fun lately, and go from there. Okay, you know this, you know that, that's me. So that's what we're doing. Foundational setups, modeling the trades, giving this an objective foundation. So it's not just, oh, it's a bull flag in isolation. Oh, it's a triangle. I've heard someone talk about this and I'm going to try that. And oh, a trend reversal. I think the market's going to fail and go down, so I'm going to go ahead and short it. Or I think it's going to keep going up, so I'm going to buy it, whatever. It's not thinking, it's not hoping, it's not wishing. It's objective, in our sense, facts or objective social science that goes back to the beginning of our business, technical analysis, takes us through Wyckoff and through the current leaders in our business and researchers and puts into objective framework. So it's something you can take right now and deploy on your own. So no matter what time frame you're doing, what markets you're trading, from the 5-minute to the weekly chart, swing trade to day trade, these things are going to work and be applicable for you. And so we'll go ahead and finish with that. But just keep in mind, it's all about practicality, all about application. It's not about theory or being smart about this. It's about applying it and doing it. And that's what's going to get your success versus not, which is just putting these things you're learning to work. And so just keeping it in terms of a retracement setup, a couple of those, breakout setup, that's just based on the principle of the market alternates, consolidation and expansion. And if you are so brave and if you are so aggressive as to do so, you do have the ability to fight trends or trade against trends. And all that just means is trends once established have greater odds to continue. Oh, where did that happen? But eventually, there we go. That was strange. Computer technology. eventually the trends will end. So a reversal trade does have a spot in your plan, but it is not the first thing you should be doing. It is probably the last thing you should be doing. I still argue or suggest that you focus on pro-trend retracement trades. And if not that, then breakout trades. But markets don't go up forever and they don't go down forever. And we have a model for objectively identifying and trading trend reversals. So again, just not to belabor the point, but Dow theory, 3 moves, 3 time frames, 3 phases, start, middle, end, and volume, momentum, internals, all those things play a part in our analysis. And multiple people have said this, it's our foundation, it is trend continuity. So trends exist until clear signals prove a reversal. Martin Pring just took that in 80 years later, they're about 70 years later, and he said this, it's the art of identifying a trend reversal at the earliest stage and then riding that trend until the weight of the evidence proves the trend has reversed. Memorize this, write this on paper, and let that be your foundational principle for trading all markets. So just how we summarize this, 3 principles: trend continuity, that's number 1. Momentum as a leading indicator, that's number 2. And the third, snuck up on us, is the alternation principle, or volatility, cyclicality. It's a fun one. And that's just basically it. The markets go sideways, which we're having right now, and they go up or down, or they trend. And we had that just recently. And so let's go. So finishing, or kind of continuing what we talked about last week with that, there we go. At the pin. Okay, there we are. Okay, perfect. Okay, now I got the pin. We're just setting up the model. So we're knowing where the price is right now. It's a concept of Mr. Wyckoff as well, and planning out where it's going. So take the current setup, the current what's happening at this exact moment, and then play that out into the future. So it's probability. So summarizing, phase 1 accumulation, usually a sideways action. Phase 2 realization, where we should be focusing our trades. The majority of your action and activity should be in a market that is rising, that is broken out of a base or consolidation, typically shows higher volume, higher momentum, and if you're trading intraday, higher internals. Everything's pointing up. In that case, you want to be a buyer of flags or retracement or breakouts. Think of a flag as a market going down and coming back up. So a flag's more vertical in terms of a setup. It looks like that, sort of. But a breakout is the same little logic, pullback. A breakout is more horizontal. In other words, your trend line is going to enter, or your setup is going to be on a break of a horizontal trend line, or a retracement's a break of a falling trend line. So it's just basically sideways versus vertical, or a slanted, I guess, diagonal. In terms of retracement, breakout, similar logic. And once distribution takes place, it is similarly a sideways activity. Little other things define that, but typically sideways action again, and the market tends to roll over. So Mr. Dow called it these things. Mr. Elliott said 1, 2, 3, 4, 5, and then ABC. And of course, Mr. Wyckoff came along and said a couple other things. This is no longer realization, it's mark up, and then not so much distribution, but a 4th phase, mark down. So anyway, that is the model, and our trades will fit like pieces of a puzzle inside of the model. So that's what we're doing. So I won't talk too much about that on this one. We're looking at, this one here. Jump back a little bit to, there we are. 1 second. Out of these little, Okay, cool, that was neat. So that's what we're looking at there. So there's our principles, and as we trade through. So here we are. Just to be clear before we talk about models again, we're looking at execution tactics. So how do you do these things? Once we model a trade, how do you put these things on in your account? How do you risk the money? How do you manage the money, the positions? I had a couple of email questions about position size. We'll get into that too a little bit later on. So basically that's it. When I'm working with clients, when I'm doing mentors or teaching one-on-one, I have them send me their trades. And so we're going to judge, it's not the right word, but assess or evaluate their performance objectively. And it's going to be this. So kind of focus on these 4 points. It's recognition. So like eyeballs. Did you see it correctly? If you're taking a retracement trade, It's like, okay, there I'm checking the retracement trade. Did you see the retracement trade? You're looking at that. You're looking at the computer screen, right? Did you see the retracement correctly? And if you did, check mark. That's good. Did you enter and execute the trade correctly? So there's models and ways to do that. And so that's how we do that. With a break of a trend line, the touch of a moving average, etc. Managing your trade has to do with your initial stop and potentially your initial target. So the market should do this, and your target will be placed up here. If that doesn't work, your stop will be placed down there. And of course, the market does what it does, or it doesn't. So your actual trade is, did you exit before? Did you get scared as the market started to go down a little bit, and you exited somewhere here? That's inefficient. So it just basically, did you manage properly and then exit? Did you exit the trade at your specified target? Did you maybe hold on, let it go above it? Or again, same thing, did you exit a little bit ahead of the target? So that's how you're going to be objective and begin to progress as a trader, because you're essentially objectively doing these things. Recognition, entry, which is initial stop, initial target, management, and then your actual exit. So entry and then exit. So anyways, judge that as you will in your own trading plan, your own trading journal, and your own trading activities. And just kind of reviewing. An inflection point means the market's either going to go one way or the other. Buyers are going to step back in and push this higher to continue the trend, or on the opposite or alternate thesis, if they don't do that, then anyone who is buying is probably putting stops under the trend line, and they're probably going to get hit, and the market's probably going to fall successively as those stops are triggered, including yours. So the logic, if you do not put on a trade, you're waiting for the market to tip its hand, to move either as it should, that's our dominant thesis, or as something surprising, which is our alternate thesis. And if you might guess, when something should happen but doesn't, often leads to bigger moves in that mean old alternate thesis. You saw that happen on Wednesday when the market broke its trend line, had some good economic news, and was kind of jumping up in the bullish perspective as the S&P and NAS and other things too. But the Fed Reserve minutes basically came out and said, we're going to probably start to taper back and pull back some stimulus. Oh, and by the way, the stock market's probably overheated. It's probably overextended. That's a double whammy. And so what happened? Investors' knee-jerk reaction sent the market a lot lower. And once you started breaking the trend lines, that exacerbated the selling pressure and kept the market going down. So anyway, just keep that in mind. So you're either going to enter or model your trading behavior to enter at the inflection point or as the market moves away from it. There are advantages and disadvantages to both strategies. Of course, you're going to be early and have a tighter stop if you are closer to the inflection point. But if the market starts to fall and doesn't even remotely go up, you're going to have a losing trade. Whereas those who waited for the market to do something else, which is maybe break a trend line, break a reversal candle high, or other factors, would have a little bit of a disadvantage because you're a little bit further away from the trend line at this point. You're a little bit closer toward the target, not by much, but it can add up. But you'll typically have a larger winning rate percentage because when the market has an inflection point and it starts to move up away from it, it probably, odds favor at least, will keep moving up away from it. So balance that as you will. In terms of executing at a touch rule, call it touch, or the alternate, which is a break rule. Break means it's going to break a trend line, break above a reversal candle, and after the touch has taken place. So we'll kind of skip that because that's in last week's presentation. All right, now we're talking models. So the model is there for your convenience. And I think we had some good little breakthrough light bulb moments last week in terms of what a retracement trade actually looks like. So we can see it all take place, but remember, if you remember the last week's presentation, a retracement profit, so this is your up, down, up. A retracement trade from entry to exit looks something like this. It won't get the absolute top. It's actually going to hook down a little bit lower. So retracement trade almost looks like a candy cane. So that's at least a conservative one. In other words, your market is going to hit this and start going down, break a trend line, and thus get your exit. So your entry to exit might look something like that. So anyway, that's what a retracement model looks like. So we're talking about breakouts today. So today's session is going to be finishing our thoughts. I kind of went quickly because I wanted to get everything in there, but realized we had a fifth session. So let's not have to worry about rushing through breakout trades, which are very important. So a little bit of review and refresher on this one. So a breakout trade, this is how you're going to identify those. That the market is in a sideways trading range. You have highs and lows, and you have maybe the Bollingers, maybe that forms a high, that forms a low. Again, so Bollingers are there to help you in terms of range contraction. And if you're looking at triangles, remember triangles, also a range, require 5 points. 1, 2, 3, 4, 5. Otherwise, it's not a triangle, and that also counts too. So that's what the basic move is there. When the market breaks through its trend line, you do want to see volume and momentum spike up with it. If so, you've got good probabilities of a successful breakout trade. If the market goes up and fails and comes back in, or if it goes up as you're trying to make the assessment and volume just isn't there and momentum isn't there, you're in danger. And so put your stop up tighter, and if that happens to fail, if the market re-enters the trend line and re-enters the pattern, you have an extraneous trade, a very high probability, call it a failed breakout. That's what happened on Wednesday, failed breakout trades. And as we just mentioned earlier, bigger moves typically come when the market should do something but doesn't, and essentially traps and tricks the traders, forcing them to exit. So you get a really good trade if the market fails. Or the breakout fails. If the breakout does not fail, you get 3 spots to put on a valid breakout trade. The first is on the I don't need proof, I don't need information, it's a breakout, I'm getting long. Full stop, that's it. That's aggressive. You will have lower win rate because some trades will break and then fail. The alternate, or the second way to do that, is, I like this one better actually, it's called the retest, or the touch rule again. So the breakout, then you can assess the volume, yes or no. When and if the market retests or touches the breakout, that's a fantastic spot to get long or short. You have a very tight stop, be at the midpoint is your minimum, probably favored on the opposite side of the trend line, and you're actually at the best spot to trigger the breakout. Option traders, you probably want to watch these little things, these little factors right there. If you don't want to do that and you want even more proof, then you will do the third point, which is the breakout rule. So let the market go up, let the market retest, let the market break the high, and that essentially becomes an official breakout trade. That's the last spot to get in. There's no more spots to get in. That's it. You've missed the breakout if the market is going above. You lose risk reward because at this point, if this is to be true, that's going to be the heart of your breakout, the biggest part of the move. Realization potentially, or essentially this right here. You do not want to be getting long into this market. It's just essentially there's no place to put a stop and no place for a target because the market typically begins to accelerate, leaving you behind. So again, you've had 3 chances to do it. If you miss it, it's day 3 or 4 after a breakout, look for some other stock. Count this as an experience that you're learning from and not that you're trading. Or we saw this in gold, I think last week too, with respect to when you get a breakout trade, just like this. If that's a breakout maneuver, the market is not going to go straight up. It's going to make its cute little retracement, cute little pullbacks, that kind of stuff. So if you miss the breakout, notice that this trade did not come back and did not retest the break. Then you have the ability to trade retracements. So that's your initial break. These are subsequent and simple, even one there too, retracement trades. But just keep in mind that a breakout model is on the break, on the retest, and this one didn't do that. And if you did that, there's no breakout trade. It just, by definition, doesn't exist. So you're trading retracements, which are pullbacks at that point in time. So notice this again is Google. You had the break from 460. Gosh, that was nice, wasn't it? Google's higher than that now. 460 on extremely high momentum, and in this case, extremely high volume. Call this a confirmation. Confirmation, it's Dow theory. And subsequent pullbacks and retracements, and you're into that breakout market. Now, why we want to care about breakout trades, especially if you are a swing trader type of strategy, longer term, hold for a couple of weeks, maybe a month, put one position on, let it go, you typically can play for big targets. If you look at R multiples, Van Tharp's type of R multiple strategy, where your risk is considered a R, position R, and your multiples are targets, so 2R, 3R, 4R, multiplied by your risk, you can get some good targets from that. Essentially, you're going to hold as long as possible until price breaks a trend line. So, and it's essentially doing nothing else, holding the breakout, or doing targeted breakouts. We talked about that earlier. So a little target, it goes up, but this one just kept on going. So play this as long as possible. More breakouts than not, generally going to fail. That's our model, at least. You're going to have less than 50% chance of success on most breakout trades, but the ones that do are going to get you 4, maybe 5, maybe 6 times your initial risk, which is going to be defined as your entry to your stop loss. So these are for gutsy traders. These are for experienced traders, maybe even options, because that way you can just put a trade on and let the option go, but that's, another strategy, another discussion. So that's basically the setup for that. You do not want to do, we'll see this later, you do not want to play for small targets and a breakout strategy. You're going to get 50% or chance, 50% or less trades will be correct if you're playing for about a 1-to-1 or maybe even a 2-to-1. The math is not going to work in your favor. So you need to have at least probably 3, 4, or more. Would argue 3 is probably the minimum to start targeting or playing a potential breakout trade. So I see this happen with clients a lot too, and in my own trading, really. It's sort of a doubt factor. You're like, oh, it can't go higher. How much higher can this go? The moment I get in is the moment it's going to reverse. I'm sure we've all said that. I've said that 1,000 times too. But this is what we started with. We started our presentation, our class with principles. These are principles. Markets tend to expand and contract. After a contraction, you get an expansion. A trend in motion has greater odds to continue. And if that trend is confirmed with volume and momentum, you've got essentially a triple factor principled odds favoring additional continuity. So when you're playing big breakouts, think what happened recently in Amazon. We'll talk about that, but just think if for the last couple of weeks in Amazon, if you start to play all cute and simple, or sorry, complex with it, and oh, I can't get in, my rules say I've got to use a 2% this and an ATR of this and that, and then you start adding rules onto these things, you will miss the trade. And if you miss the trade, you can't get back into the trade. And if you can't get back into the trade, that's not the worst of our problem. That's not the worst thing you've ever experienced. Missing a trade, that's not hideous. But if you do this repeatedly, your end of the year portfolio will be lower than somebody else who does, who simply just recognizes it for what it is, a breakout, get in, supply demand, supreme differential, huge imbalance in supply and demand, get in, play it, don't, I hate to be cute with it, don't be perfect, don't let perfection be the enemy of the good or the breakout. So they are very powerful. And just to be honest, this is my 16th going on 17th year doing this as a trader, researcher, analyst, teacher, all that kind of stuff. I really think this, you just got to see them. It's not something I can tell you and teach you. Well, I can, and I'm doing that, but I'm just going to tell you from experience, the way you're going to trust these things is by doing them. So I wish I could impart all the knowledge I have, but honestly, you're going to have to get in there and sort of get your hands dirty with these things and see that they really do keep going and that they really do go beyond what you think they can do, and that you really do need to execute, close your eyes and hit the buy button or the sell button and manage appropriately. Don't just say, oh, well, don't talk yourself out of these things. That just comes from trust, from experience. And the same thing, if you try to get those limit orders and save a couple $100 or $20, $30, $40 in your execution by getting a perfect fill, you probably might miss 1,000. So great job saving 100 where you didn't get 1,000. Not the way to trade necessarily. So the way you put rules on these things, keeping in mind what I just talked about, keeping in mind, if you're aggressive, you just get the trade on market order at break. That's as simple as it gets. That's as hellaciously aggressive as it gets. That's going to be feeling really weird. You're going to feel like you're chasing the market, and you probably won't want to do. You won't feel good doing it. If you don't want to do that, and that's okay if you don't, you have a couple of other ways, or 3, to do so. Wait for a 2-bar close outside the range. So day 1, day 2, then get in. And so even if it keeps on going, you might miss a little bit, but it's going to save you from going down and failing on that. And essentially a trap. It's going to sidestep the trap. 2 days is a good testing metric to save a trap. Similarly, let the market go 1 or 2 ATRs. If that's 1 ATR, that's 2 ATRs. Enter, execute when the market pushes up 2 ATRs above the breakout. And otherwise, this is only for swing traders, not for day traders, do a percent rule. So if this is percent now, 1% up, 2% up, execute up here. All right, so same thing. We just talked about this, kind of summarizing. I know we want to, it's for time's sake, we won't sort of discuss it, but think in your own minds. Would you get long here? Would you get long there? And of course, think of what we're doing. We're teaching a class, so this isn't necessarily the real world. It's a example, but if you miss the breakout, there is your 2-bar rule. It's also maybe 2 ATR, etc. So if you miss the breakout, how do you get into this? And if so, what point do you hold? These are things you have to sort of deal with in the real world. And it's going to feel weird. It's going to feel disgustingly hideous to execute into a market that has gone $20 up, or about 20% up in 2 sessions, really more than that. Yeah, would you do it? And if you did it, here's where you would execute. So I know what you're thinking. There's 2 thoughts on this. Thought 1, oh, I tagged myself in at the absolute high, it pulled back, and I wish I would have waited. All right, that's fine. If, again, same thing, you typically do get a pullback. And if so, that becomes a retracement trade, right? Retracement. But if you got yourself long here, and the next couple of weeks the market went down, and then assuming you held until it got the target was a prior high at about 160, let's say 160, right? 160, there's your prior high, there's your high. If you got in at, say, 140, you got $40, period. So you're not feeling that bad, right? But if you second guess yourself or all these other factors, you might have missed out. Now, granted, waiting for the pullback was a superior strategy, but what happens in a case like this, where this is a Sears holding way back when, not anywhere near now, but this is back a few years ago, where there isn't a pullback, there isn't a break. It's essentially just down to up and then above. So something you have to determine in your own trading plans and your own methods and your own sort of push-pull when you develop your strategies. Do I execute immediately on a breakout? Do I wait for a pullback? Caveat, the pullback might not come. Or do I just close my eyes, hold my nose, and get in? And so that's something I can't tell you, and even nobody can tell you. That's just going to be how to enter a market that is breaking from consolidation. And that's something you have to decide on your own. So even though this feels grossly hideous, the end result was a market sailing up to 160. And that's $40 of profit as a swing trader. That's quite admirable. And we talked about that too. All right. Similar, not to belabor the point, but it's the same thing. Triangle breakout, entry 1, entry 2 on the pullback. Didn't quite pull back, but that's good as it gets. And otherwise on the break of the high. Nothing really fancy about that. It's just difference in a rectangle and a triangle. That's all that's different. And in this case, what's different from a rectangle to a triangle? You get a measuring rule, like the flag, right? The flag has up, down. We're going to take this, plot this, and go up and measure that. A triangle, similarly, we talked about it because that's our pattern recognition, but it has a measure move. It is called the height of the triangle, right there. So take it from the top of the trend line to the bottom, Remember, extend it down to this point, extend down to from the top to this, not to this, that one, and then project up from the break and hold your trade from there. We talked about this because you can also get little swing trades. You can also get little buy the pullbacks in the context of a breakout. Remember, a breakout trade is going to hold through the pullbacks. That's a management issue, trade management. If you exit, get scared up here, you left this on the table. Not appropriate trading. It's conservative trading. It is not appropriate trading because a breakout trade holds to the target, and you didn't do that. So you made a trading error if you were trading a breakout because that's not the target. So again, hold and let it go, or think about trading the pullbacks when and if they occur. So again, just kind of summarizing the breakouts in general, if you are a new trader, I don't think you should do these. I think you should paper trade them, research them, watch them, don't do them. Let your experience build from a safe environment and then begin to deploy your capital, your assets, into when you get more experience. So start small, build up from there. Markets will always break out. They're not going anywhere, so don't think that you've missed because you missed one break, I didn't trade it live, that you're permanently never going to catch one again. Markets do this all the time. So it's better for aggressive traders. Again, same thing. I really can't emphasize this enough, that do not play nice, do not play professional, and do not play perfect. If you do, you will not get in the trade. And if you do not get in the trade, not the end of the world, but you will have missed a good opportunity if the market actually does do what it should have done, which is breakout. And just think what's going on. Why is it doing that? It is a huge differential in supply or demand. One side is completely dominant over the other, and that's what makes these things happen. So again, sometimes just simple trend lines. Find a trend line, get into it. Squeeze of the Bollinger, break of the Bollinger, get into that. It doesn't pay to be really deep level professional, or deep level complex with this type of a model. This is different than a retracement. If you don't like this, do retracements, and that's fine. If you don't like retracements, this might be for you. So just, you don't have to do anything I'm talking about, but if it works for you, definitely do it. So again, same thing. If you exit too soon, your account will be lower than someone who doesn't, because they will have a larger net average dollar win, because they're going to hold trades longer than someone who just jumps out at the first little sign of weakness. And if it really is a true breakout, it is going to have pullbacks. And if you get scared and spooked out of a little pullback, that's not how the model works. The model is to capture as much as possible until it starts to diverge and start to break down, break a trend line, and fall the other way. So if you're going to get out here, you might as well be trading retracements, which is fine. Nothing wrong with that, but this is a different type of method. The breakout would capture from low to high versus a little retracement going to capture smaller points of the move. So that's what we're trying to model out. All right, so let's flip that in reverse. First off, any questions so far? Any discussion on what were the breakout trades, edge, stops, targets, model, where you take the trades? Any questions so far before we sort of do an immediate U-turn, talk about the opposite, which is fades? Aha, okay, good. Keep the questions coming if you do the questions in there. So let's talk about fades. So this is something I liked, well, today, yesterday, and I guess today were range days necessarily, but these things have our precedent. They have, let's see, a good point. Yeah, Tom says, great point, trading the pullback. Yeah, exactly, yeah. So Tom says, great point, trading the pullback if you miss the initial, say, triangle entry. Exactly right. So that's the thing, I keep saying, if you miss it, you're gone. That's not true. If you miss a breakout, you miss the breakout. You really can't hold for, in terms of the model, but you can trade the retracements from that point on. Absolutely, absolutely correct. So don't feel like you missed it. Just feel like, well, you did miss the breakout. The train left the station. The train's going to slow down a little bit and stop and let you on, and then it's going to maybe slow down and pull back a little bit, but you did miss the initial breakup. But there are other points to get into a moving market. All right. This is not one of them. This is not how to get into a moving market. This is a range fade. So this is established. So if you're looking at this with a Wyckoff principle, that what's the market doing now? What's it about to do? Then what is it doing now? It is ranging. And look where the trades are. The trades are not here or here. Why might that be? And again, just kind of time sake, it is not the case that you can assume that this is going to trade into a range, which is 1 or 2 points of data. This has, at this point, 1, 2, 3, 4. It's got 4 points of data. This has 5 and this has 6. That the market is in a trading range. And all you do, you're going to find from the model that this is it. Play up away from support. From there to there, the target is here. And you have what's called a flip reverse. Flip reverse. So you go long at this point, you exit your long and flip reverse short at the high. And then of course trade that down to here. Assuming the market does hit that and inflect up, you flip reverse the other way. This is what it looks like. So a green trade is your buy either on the break of a trend line, break of a reversal candle, or touch of the little Bollinger of the trend line there, and then of course playing up toward the resistance, and then fade it down, fade it up, ad nauseum indefinitely until the market breaks out. So let's go back in time a little bit, talk about our shield, Sears Holding. So we don't know just yet, but let's say as of maybe this point or that point, got a pretty good clue that the market's in a trading range. So down to up doesn't quite get down here. So you really get about 4 trades there. Trade 1, trade 2, trade 3, trade 4, and we don't really affect the model at that point. The model does not trigger because the market does not touch the trend line. And thank goodness we didn't get up to here. The market broke above, and this no longer is a short, clearly not a short because it's above the trend line. This becomes a breakout. So that's how you would model out range fade trades. Here's a good friend Google again, which is the same thing. We don't quite know. We don't know if that's actually more of a retracement trade, this right here, not a fade. And this right here is not a fade because this trend line doesn't exist. This is not a fade. Let's see. Albert says, can we confirm a reversal at the edge of the range by looking for a reversal first on the shorter frame? Yes, yes, yes. So let me repeat the question. Can we confirm a reversal at the edge of the range by looking for a reversal first on a lower time frame? Yes, 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 yes. I don't have an example of that, I don't think, but just kind of picture with me. And in terms of lower time frames, yeah, so let's talk about this real quick, this right here. So visualize with me this little piece in time, about February 2006. So this is Shield again. So Shield's gone to the upper spot of the range, and let's say we're going to ask the question, is it more likely to fail and fade back to the low or go on a break higher? So the next day is essentially it's a bullish candle. The next day pierces above it, right? It goes above. That's a breakout. You're above the trend line. But the volume on the lower frame is lower. The momentum might be diverging. If you're looking at internals, they're peeling off breath and those sort of things. And so not to mention that, but the market goes up and it starts to fall really quickly on high sell volume on an intraday chart. Well, the odds would favor from this point on, it probably goes down to test out the low, which is down to this level. So that's correct. Versus if, the same thing here, same little logic at that point, versus if the market did do that and did start to break above, it's the same thing, right? But it did so in a huge gap and volume was way up and momentum was way up and new highs in those metrics, it's probably going to continue. So you can absolutely figure in and factor whatever you're looking at on the higher frame to a lower. And the same is true for a retracement. If you're kind of playing off this right here, let's say, or even that right there, you might look to an hourly chart or 30-minute chart, and you might find out that you're having momentum divergences and lower sell volume as you test out a key pivot point for a higher time frame. In other words, you want to buy a retracement. That's what you want to do, period, full stop. And so maybe you want to get some more confidence, drop down to a lower frame, figure out that, oh my goodness, here's my little spot, here's the spot I'm looking at, and oh, here's the price forming positive divergences, and volume on the sell side is going down, if that's sell volume, let's say. So you have a model for a trend reversal, right? And as the market starts to break above that, you can get into a essentially reversal. Maybe it's a sideways trend, maybe it's a breakout. Whatever it is, it is a lower frame that gives you more information to get you into a successful trade on the higher. Absolutely correct. Okay. So the same thing, same little model here. So down, up, maybe a divergence there, down, short that. Good little reversal candle. So you have probes under. This is a great little trade because Google's in an uptrend. 200-day simple moving average, lower trend line, a good little daily bullish reversal candle. That's about as good as it gets. And maybe, just for fun, the termination of a bear flag, dun, 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 and maybe we have positive divergence. I don't want to get too complicated, but that's, I'm getting more advanced for this class, but these are things you might want to think about for piecing together more parts of the puzzle on a lower frame. The market starts to break its trend line, and there is your entry. Your target is the higher trend line, which eventually it did, and it actually went higher than that. But so Google here had 4. Again, you can't start fading trades down to this spot, but once you start to figure out that, oh, it's a trading range, that's when you begin to engage the market for little fades. So we're targeting these things and playing for large or small targets. This is kind of big for your portfolio, and this is more stuff for modeling your portfolio. So if you're trying to play just a retracement strategy trade only, you're going to have, we talked about this earlier, generally a win rate of 60 to 70% if you're doing it right. Retracement trades have a higher than 50% retracement or success rate in terms of they work more than they fail, but they're going to get about a 1-to-1, maybe 2-to-1 at the best reward to risk. So that's a trade-off. So your account was going to look, if you just trade retracements all year long, your account will look about like that. It will look similar to the model minus any psychological factors that tipped you into messing up the trades. Or, well, yeah, you can't, essentially, are you applying the rules correctly, or does something scare you, spook you out? Are you too large for your size? Are you too small? Are you too conservative, too aggressive? It's all the mental game at that point. But assuming you're following the rules, your end of year model or monthly model should look like the retracement model. Or if you're doing breakouts, your model or your performance, your account performance should have probably less than 50% correct trades. In other words, maybe 30% were successful, maybe 40% in doing well, but it probably will not be above 50. That's just the model. Nothing wrong with you, it's just how breakouts work. But the ones that do work should get at least 3 or 4 or more times what you're risking. So if you're risking $300 per trade and you're getting back $900 or maybe $1,000, you can get away with having a less than 0.5% win rate. And again, if you mix and match these things, that's when you that's what your performance will be like. That your performance will not be like the model. My performance is not like the model either because I'm doing different things. So just keep in mind, if you just focus on one specific strategy, your end of your portfolio, your metrics, your data should look like that model. And if it doesn't, something is going wrong. And of course, you would address that, and it's probably going to be a psychological factor, emotions or something else, which is way beyond the purview of this presentation. So retracements will play for a piece. They're a piece of the target, a small, precise target. You will never, ever have, by definition at least, a large target retracement. They don't exist. They can't exist. It is not possible. And when the market does this, you're playing for that. And so even if it goes way up, a retracement is going to be a piece of the movement versus a breakout that tries to get, or a reversal thing, that tries to get as much as possible. So anyway, keep that in mind. There are theoretically unlimited targets for playing a trend reversal, and why it sounds cute and fun and all, but it really is. You're playing essentially for the model to reverse. I had a couple questions on that too. And so you're going to keep playing or holding, if you did like say what's called the sweet spot trade or the TCZ, the trend confirmation zone, higher high, higher low, take it out, moving average across, yada, 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 your reversal model, you would hold long indefinitely until the price starts to go lower low, lower high, distribution, break it down, you're going to exit at that point. So theoretically speaking, a reversal trade like this, called a core trade or a TCZ or sweet spot entry trend reversal trade, would have an unlimited target. And so that's pretty cool. And breakouts, some breakouts, again, hold as long as possible. Now a triangle has a fixed target. Remember, the triangle is the height. Once that's done, the trade is over. The breakout is finished at that point. So a triangle does not have a unlimited target. It's not a fixed target. Flags have fixed targets. It's up here. From that to that, that to that. So your fixed target is there. It's done. But some breakouts and clearly trend reversals have unlimited targets. So I think, this is a question, Albert had this question too. So I do mention, I thought I did in this presentation, but actually I do. So integrate your dual time frames. So if you find a small target time frame on a higher setup, this is exactly what Albert talked about. Let's talk about retracement. So up, down, right? There's your retracement trade. The retracement trade is going to go like that, and that's it. It's over. It's going to stop right here. So there to there is the proposed retracement trade. All right. But if you then jump down to a lower time frame, you might find out that you're having this take place. So if this is your little flag, right? That's your flag on the daily chart. It's going to look like this: lower low, oh, higher high, higher low. Moving averages cross bullishly. Momentum kickoff, tick kickoff. What else? Everything else takes place. That's quote unquote an unlimited reversal target. So if you're just looking at the 5-minute or 15-minute chart, you might have picked up on a reversal trade and put on your reversal position, TCZ, which is trend confirmation zone, or sweet spot trade, core trade. But that happens to correspond not in isolation, but it's just a little pullback up here on the daily. So it's maybe 3 weeks or something, or 2 weeks pullback. This may be a couple of days. So if you get a lower time frame, unlimited, let's say a trend reversal or maybe a breakout that happens to be into a fixed target on a higher frame, pretty cool. Maybe put some extra leverage on the table if you're getting these types of signs. This is what I teach my students. This is more of an advanced topic. I mean, I don't really talk about it much in sort of intro, not the intro, intermediate classes, but this is how you would combine the models and combine them together. Yes, Albert, exactly. That's exactly it. Exactly it. So Albert asked, is the advantage of doing this? It's more work. Let's be honest. It's more work to sit there and look at 2 time frames. Is the advantage that you can get a tighter stop? Yes, 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 yes. If your stop is down here on the daily, right? Let's say it's 2 points, $2 if you're trading something like that. If it's a $2 stop right here, by definition, your stop is going to be on the opposite side of the trend line on the lower frame. Super stops right here. That stop might be 50 cents, could be $1. So you're getting the advantage of having a tighter stop and more information than you would otherwise have if you just looked at the daily, which is fine. I don't want to poo-poo that. If you just look at the daily chart and stop there, that's fine. For a swing trader, you don't want to do too much work. That's fine. You got that. But if you want to do extra work, if you just love these things, it clicks with you, it makes sense, and you have the time, you can jump into lower time frames. And if you get into a lower time frame, you will have the advantage of having another data point, or multiple data points for that matter, and inherently correct, tighter stops. If that appeals to you, that's something definitely to look into. All right, wonderful. So questions, keep the question. Any other questions so far? We've finished the modeling part. We're going to see this how it plays out. So far so good? Going through a lot of material, so you all are doing really, really well. Okay, so just kind of double, triple, quadruple teaching this, that a market, this is Dow theory, it's also Wyckoff, it's also Elliott, it's just this is how the markets move. They go through a phase 1, they go through a phase 2, they go through a phase 3. That's it. So your trades are going to be based upon movement, or I guess I should say your ability to recognize what's going on and how to deploy your resources, essentially. So when you're in a trending environment, which Corey, I want to focus your attention on this. I want you trading that. This is me being personal, so take that for what it's worth. It's not me being textbook, it's me being experiential. I want you trading in realization. So if you do that, you're going to be trading retracements from the moving average, typically to the Bollinger. Maybe you're trading breakouts. So a retracement, again, just to be clear, is buying the pullback, and that, buy the pullback, and then we kind of get a pullback up here, but it starts to get dangerous, right? Or you buy the breakout, which is a horizontal maneuver. So the breakout would be here, would be there, and would be there. The problem with that is eventually it's going to run out of steam. So you're going to kind of fail pretty hard when the market starts to go the other way. So in your realization, you do get spots to enter a breaking out market. So I want your attention focused on that. I don't want it up here, or for that matter down here, because there are no retracements. It's not going to work. Or I don't want you to do this, but if you can't resist yourself, we don't have the Bollinger necessarily, but you're going to play the opposite way. So fade this down. So in a trending environment that gets overextended to the Bollinger, or maybe at a lower time frame divergence, you're going to try to fade it down to, you can't see that one, but that kind of fades, the Bollinger. This is contra-trend trading, contra-trend. Eventually it's going to work out to reversal, but you can't bet on that. So I think retracements are inherently better because you're going to cover more ground and you can make more mistakes. If you mess up, if you short here, let's say, the market goes up, it stabs you out, you're going to have essentially multiple losses. You're not going to have too much fun doing this, but I didn't want to just not talk about it because that's part of trading. So fade trades do well in a range. Again, we're not saying Bollingers, but if they're there. They don't do as well playing into a realization or trending environment, but they certainly have a spot for you to do that. I don't want you to do that, but if you want to, it's there for you. If you're in a range environment, that's where your fades come in. There they are. There's your fades. So a range environment is going to play little fades. Up to down to up to down to up. And that's not really quite a range up here, but if it were, down to up to down. Anyway, so a range consolidation environment needs to have those fades or get ready for the breakouts, which is right there and right there. By the way, if you're trading the trend reversal, the TCZ, so you get a higher low, higher high, et cetera, the breakout model, you're going to enter there and try to hold as long as possible until price starts to break a trend line. So, or make a lower low, lower high, whatever you want to use as your metric. So the TCZ is going to take it from there to there, will be your trade. As opposed to, well, not opposed to, in addition to, doing the retracements along the way. So anyway. All right, so Micron gives us, let's talk about this real quick. Micron's a pretty cool little stock here. It's been doing a lot of bullish things in 2017. So this particular example goes in a full cycle. If you look at it closely, you're going to see 3 cycles, which is 1, 2, 3. Let's get that off. And so there we are. So what would you do? Just, I won't draw right now, but just you can write in the chat box or just think about what would you be doing? What would be your strategy, let's say, from 2013 to 14? Right about here. What would, forget the rest of it, but what would you be doing up here? Give you some hints. Yeah, think about it. Yeah. Answers coming in. All right. Albert and Brian and Tom say buy retracements. Buy retracements. You got it. So the metric for that is new high in momentum. There's 3 of them, actually 4. Sorry, 4. There are 4 new highs in momentum. And there's subsequent new highs or confirmation. And we don't want to look at spikes in volume necessarily. We want to look at the trend. So the trend in volume is up to bullish. That starts to change in 2014. We start to have an aberration at about this spot. So it's basically from here to here at that point. Momentum still goes for a high, but your final peak, your top, so we just well, okay, just go forward in time. That's what you're talking about. So yeah, Tom and Albert, Brian, all those retracements, that's the model that you want to trade. So basically getting up to the Bollinger and getting out, from the moving average to the Bollinger. That's a retracement core type of methodology. So that's what that would have worked here. Okay, so that's that. And oops, all right. So then we start to go into 2015 at the 35 per share level. What's going on? What's up? What's happening? Walk me through what's going on in 2015 at the all-time high. This is, I mean, the all-time high, but this is on the chart. What's going on at 13? Now, Tom says divergences, momentum. And Brian says a trading range. Yes, that's an advanced answer, but yes, it is the trading range. So we're tracing into a trading range. Remember the model. The model is sideways, up, sideways. And what is this? Sideways, up, sideways. You got it. And so in a trading range with divergences, it's more akin to a probable, not guarantee, probable distributive environment. And so I think Wyckoff would call that the spike or the upthrust, and all the little market profile calls it excess, all the different little terms we use for that. It's essentially a trap. The market tried to break out, it failed to break out, and so something else is essentially going to take place, which is a eventual reversal. So why do we not buy this pullback or that pullback? Because the momentum is peeling off, volume is peeling off, and we're starting to see this declination or sideways action in the trend. The trend is weakening. So your strongest retracements will be in a realization environment. And so once that other thing happens, once you get a lower low, lower high, take it out, the trend has reversed as of right here. You also get bearish volume coming in too, and new lows in momentum. Yeah, it Tom says a TCZ, a trend confirmation zone. So remember your TCZ is going to be the spot that it makes a lower low, lower high, and then it subsequently takes it out. And that's going to be the spot that the market has done a trend reversal by your metrics. Also, the moving averages cross, we're underneath them, and so we're going to short sell into little pullbacks to the moving averages, right? Short from the moving average to the Bollinger. In this case, it got really, really nasty. So a new momentum low, volume on the downside surges, we want to short the pullback. We don't really get a pullback until about the end of the year. And then, of course, then down she goes. Now, what's happening here? At 2016, we have, I'll clue you into it. So what's going on in 2016? What about there? Want to jump in? In the trading range. Yeah, Brian says another trading range. That's right. The trading range is going sideways, but yeah, exactly. But it's diverging. So same thing earlier. We're having positive divergences. Now volume still is bearish. If you look really closely, the market pumped up and did a new low at 10%. There's actually a new low on an even grosser, bigger divergence, but this time by volume. So the market subsequently goes, breaks out, there's your, you can't see it, but go back and look in your own time frame on Micron, and there's your breakout. That's mid-2016, higher high, higher low, higher high, higher low, take it out, break the 50, whoops. There's your TCZ, trend confirmation zone, or sweet spot, or core trade. Lots of words we use for that. So buy the pullbacks, and then new momentum highs, bullish volume, and that takes us to where we are kind of today. All right, so that's your cycle that way. All right, we just talked about that too. I think Tom mentioned TCZ. Where's your core trade? Core trade is on this to there. Notice that you didn't need to do a whole lot of work. Lower low, lower high, take it out. But that would have got you from 10 to about 30. I'm obviously doing simple math, but there's your core unlimited target trade, right? From this to that. Notice that you missed the high. That's what the model says. This is the model. You aren't trying to get the high. That's not part of your goal. Your goal is to get from high, high, low, low to low, low, high, high, or low, high. So, and of course, the moving averages play into that as well. Subsequently, if you might want to enter short here, or I just put it there for easier reference, low, 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 high, and you're going to exit on the TCZ, high, high, higher, low, take it out. And on the way down from that model, you got, let's see, 25 to about 15. So, but a $10 movement. In this case was about 20. Essentially, core trading at 20 bucks up and 15 bucks down. And again, this is the weirdest thing I teach people, but it is technical analysis because you aren't trying to catch the bottom or the top. All right, how many times have you done that? How many times have you failed? Kick it out. Stop. Don't do it anymore. From today on, never, ever, 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 ever try to catch a top or bottom. Never, ever do it. The model suggests that can't be done. Is this the bottle? Is this the bottom? Is that the bottom? Is that the bottom? And even right there is not the bottom. It goes on one more time. Is that the top? No. 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 Yeah, finally. So I just kick it out. Stop. Save yourself a bunch of headaches. And again, this is not the only way to trade, but it is one particular way to do so into a trending environment. And I think this is what Brian was mentioning too. There are range breakouts within the little structure. Particularly, I didn't really draw this for educational purposes, but you can do one there too. So break to the up, break to the down, and I kind of stopped there because it was a measured move type behavior. So anyway, measure move, so on and so forth, so on and so forth. So you get little breakouts in the cycle. Break up, break down, break up, so on, so forth. And so close your eyes, don't look at this, don't look at this. If you can't resist doing a fade type methodology, counter trend fades. It pains me to teach this, but here you go. This is what the model, I didn't do it there necessarily, but this is what the model will show you. That you can get money, you can make money trying to short the Bollinger to the moving average, right there. So, yeah, but this one didn't make it to the Bollinger. That actually might have been a losing trade. Actually might have lost on this one. That was fine. It was worth probably like $3. Probably about worth $3 or $4. So this was a good one from the Bollinger to the moving average. This was a fail because that was from the Bollinger not to the moving average. That would have failed if you did that one. That would have failed, so on and sort of so forth. So anyway, a fade might be here going back. Maybe fade that up to there. This would have failed because it didn't quite get there. Anyway, so do as you wish. Amazon. This actually happened. Reason I was discussing this with the client too. Let's see. Albert says, oh, Tom says, I got a couple questions coming in. Let me jump back in here. All right. Tom says, how can you forecast shorting the Bollinger Band? I'm thinking of forecasting a retracement trade. You know, in my experience, I don't think you can. I really feel like in the market structure, if the trend has greater odds of continuity than a reversal, if that's true, then you want to align yourself with the trend. And that's just sort of the way it works. But a trend by Elliott, by Wyckoff, and by everybody who talks about Dow is going to have swings and waves. So when you're in a market that's overextended, let's look at this. I can't really zoom this in. Let's sort of visualize, go back in your own time, on your own charts, and look at Micron in 2014. And so you see that it's stabbing up. It stabs up there, stabbed up there, and stabbed up there, and eventually got the 20-period moving average. But you would have had to have suffered through essentially 3 losing trades, and that right there probably would not have made up for it. So just in 2014, using this model, you might have actually been negative. 3 losers and 1 winner, and the winner is not that great. At times, a smaller time frame might have shown divergences. Absolutely. If you are going to engage in this strategy, you probably want to look at lower frames and sort of get in there to make sure that the market like this has got revert. Like 4 is really good because it's grossly overextended. You've got negative divergences on the lower frame, I'm sure. Volume's not so great. So that's a good example, and it kind of got you about $4 of profit. The problem is with a reversal strategy, you have to, it's just efficiency. Think about efficiency. So efficiency is work for effort. So you're working harder for less money. If that's money, less money, right? You're working really hard, got to drop to a lower frame, got to find a candle, got to find the Bollinger, got to manage your stop, got to do this, got to do that, to get not that much money. Versus a retracement trade, let's just be honest with each other here. I talk about retracements. I'm like, oh, the perfect retracement is this and that and this and that. What if you would have gotten long here, or there, or there, or there, or there, or there, or there, or there? Really, the only time you would have lost money is in a couple of weeks in mid-2014. And the thing just kept on going. If you sort of gritted your teeth and held your nose, the thing kept going. So, you know, or there, or there. So how do you, what if that's the way it works, retracement trades and this type of behavior, or just trading with a trend, is effort or work. Close your eyes and get long. I mean, let's be honest, close your eyes, get long. I don't want to teach that professionally, but let's just be honest. And their effort, the reward result, money is higher. You tell me. I mean, that's just sort of, again, I'm do it your own way, but you could forecast a market overextended has greater odds of pulling back, but that contradicts the whole, you know, trend continuity principle. So a little kind of funny story. I was with, when I first got to know Linda Raschke, who was my mentor, my person I look up to the most in the business. So she was giving a presentation back in, I think, 2004 or 5 or something, and she was discussing the trend continuity principle. Something like this, just kind of give an example about how to do simple retracement trades, something like that. And this gentleman that kept asking, he wasn't being mean, he wasn't being, you know, whatever, he was legitimately asking questions. And he said, well, how do you know the stochastic did this, and how do you know that, and what about that, and this and this and this? And she would patiently answer the questions. And then finally, she got exasperated, and she just got her little pointer and said, listen, if you just would have bought, if you'd have been as inefficient and as bad as you possibly could have been, let's just talk this right here, let's just talk that. That's really terribly inefficient. If you got long, let's say, if you're trying to go with the trend and you're trying to get all these rules going down, if you bought at the Bollinger 1, 2, 3, 4, 5, 6, 7 weeks in a row up, let's talk about it, 7 weeks in a row up, upper Bollinger, let's even say negative divergence, let's just even say that, and you got long up here, you still would have made money. Let's just be honest. And so like, that's what changed my trading permanently, was that little exasperated moment from Linda Raschke, you know, almost 10 years ago now. She just got really, really frustrated and said, if you were as dumb as you could possibly be and you still got long, you still would have made money. So that's, you know, that's, I'll never forget that. So, you know, take that for what it's worth. Albert says, rather than fade or go short, does it make sense to take profits and look for a pullback? Yes, 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 1,000 times yes. I haven't talked about this, but there's a mental aspect of trading pullbacks that it might feel good to try, and when you succeed, it feels like you beat the world, and it feels great, but there's a mental aspect because you're always on the wrong side, which is just the way it's happening. You're on the wrong side of supply and demand. So I would argue, or I would suggest from my experience, never, ever, ever, never try to fade a trending market. Don't do it. Do what Albert just said. Does it make sense to take the profits? Yes. And see, notice these trades end. Notice that. These retracement trades end. They are finito. They are done. They're in the books. There is nothing more to say about them. They are done. They're successful. And then wait to get long. And that's your next move, is to get into this. And so again, you could be the Linda exasperated principle, where it's just get long anywhere. And that won't be as effective of waiting and being more professional and buying some type of pullback, some type of retracement. And holding your stop under the moving averages. So just keep that in mind. I can't recreate that moment Linda had, but it's just, that's what, it was a moment that changed my trading forever. Stop trying to get against the market, stop trying to be this perfect little hero, and just realize what's happening, which is a big supply-demand differential, and get into it. You know, you could be as inefficient and as bad as you possibly can be, and yet still make money. It's just the example the other way. Let's say you get short there, got to suffer a couple of weeks. Let's say you get short there, you suffer a couple more weeks. You get short there, and eventually it does make a new low. So anyway, just, you know, take that for what it's worth, and I hope it's worth a lot. All right, so Amazon. So just kind of visualize with me. Yeah, Tom says smaller time frames may have shown divergences. Absolutely, absolutely. Both on the way up and the way down. Okay, so this is Amazon 15 minutes. If you saw this recently, first off, I did a scan. I didn't do it publicly, but it was to my members I did, but not in terms of like public call out. It was the number 2 stock that was compressed on the S&P. And what that means is it was a stock that had shown an ADX, which is average directional range, and the Bollinger Bands had compressed within the Keltner channels. And it was the number 2 stock that was most compressed in the S&P. And so as you can see here, and even beyond this, it had a run of about $100 in a couple of weeks. It went from I think 820 or something to where it is 920. So anyway, that's just this even goes beyond that. So this right here is just a little time frame, little peek into the bigger move from the compression breakout from a stock scan that I used, and of course you can use too. All right, so even this has a life cycle component to it. That's accumulation. That's a big candle, high volume, high momentum breakout. This is 15 minutes, right? There's your breakout. If you missed the breakout, you did, well, actually it's not true. There's your break, there's your retest. So it kind of gently went up, gently went back down, and then surged off to like a rocket. So again, your breakout position would have been that. You're going to hold that as long as possible till the market breaks, let's say, the 20-period moving average. So your breakout trade model would have gotten that. And if your stop was down here, which it should be, let's say it was 880, all right, 880, you're going to exit about 920, and that's about $40. Or no, sorry, from 20, yeah, 90. On that one is about 30. So yeah, you're playing a $30, but what wound up being a $30 move for about, this is very simple mathematics obviously, for about a $10 stop. Assuming you put the stop at the lower, if you put it in the midpoint, that was about 5, that winds up being 6 to 1. Otherwise it's 3 to 1. Anyway, beside the point. So that's your breakout. Otherwise you get a couple, I don't really call that, that's not a retracement, that's your retracement. You really get one retracement trade, well, retracement at that point, get in and maybe get out about that level because it starts to break the trend line at a higher level. So your retracement trade is going to look like this. It's going to enter at the bottom, hold this, hook over there, and get out about there for your retracement. Now, Tom was right about this. So hold on. With respect to the intraday frame, here's Amazon. This is Wednesday, by the way. There's your Momo high, momentum high. There's your volume spike, retracement. But as it goes up to 920 and above, midday, you get a range, a rounded reversal pattern. We talked about that, and really obvious negative volume. It's intraday, so kind of take that for what it's worth. And momentum divergence. So that's the play off of that. So anyway, take your profits. Again, I think that was what Albert was saying. Take your profits up here. And once it starts to break down, that's another scenario. This is, to be kind of fanciful about it, let's go how do you do this here? 1, 2, yeah, maybe 1, 2, 3, 4, 5 compression wave. So 1's your biggest, 3 is your kind of midpoint there, and your 5 is just barely above that. So you get a 5-wave thing with divergences. It's time to kind of get out of that one for the short term. And of course it fell all the way back to where it started. So range, accumulation, realization, at that point, distribution, so your secondary arc, and then as Wyckoff would call it, mark down, and all the way back to reaccumulation, probably. If not, it's a distribution move. Plus you got divergences. Anyway, so yeah, okay, that's there. Range, triangle, triangle, breakout, breakdown, range. So it's just principle that the volatility, cyclicality, which is your sideways flat, low, high volatility, high movement, and a little bit of sideways action here, down big, and then back to a consolidation. Market profile has a lot to say about that. in terms of from a value area to value areas, and a departure from value, and a return to value. That's your little movement there. So as the market breaks out from the little range here, you get a breakout trade. Pure and simple. Breakout trade, high volume, higher momentum. If you missed that, there really wasn't, I don't call this a retracement. That's not enough. Your next actual retracement was your little pullback. And this was so strong, it didn't even hit the 20. I see higher momentum, and volume starts to pick up at that point too, and momentum. So, but then it starts to peak at the top. There's your reversal candles, decline, etc., etc., etc. So basically, you get a breakout and retracement into this particular. It was a 2-day move. It took 2 days in Amazon, right there. For those who are of the mindset to do so, brave and bold and aggressive, you could have faded. A little fade, that's going to take you down to here. Nothing much to do with that. It's not a reversal trade. It's a fade. The reversal takes place with a lower low, lower high, lower low, lower high, a break of the moving averages, and the moving averages themselves turn bearish. They cross. Call it MAX, moving average cross. Moving average cross. So play that reversal. Where are you going to go to? Down to here. And down she went. On that. So anyway, reversal trade isn't that effective on this one. It's effective, but not much you could have done with that one. Fade would have worked. So just the fact that you get the market should not be bullishly pushing up away from these levels. That's the main thing. If you don't try to go against it, just know that the market probably is going to bounce off the moving averages. Not after this kind of stuff takes place. There really wasn't much to do. It was a breaking environment. I just sort of broke and went. It didn't give you any type of retracement to your moving average. The first one was up to here, and it was successful down to that point. The second one kind of took place toward the end of today's session, actually. So it's not that super wonderful. It's kind of more doing a trading range, but you only really got 2 spots to get short, to retrace, I should say. All right, so we're finishing up. Just to keep it simple. So if you trade, and this is now, it's up to you. I've given you the tools, I've given you the framework and the sort of the game plan of the board to rearrange your trades on. Take your pick. And so if you, and I'm not going to make a judgment on anything. This is whatever appeals to you in your trading performance, your trading sort of metric with how you trade, basically your risk tolerance. If you trade retracements the end of the year, or if you do quarterly or monthly, you're probably going to have a greater than 50% retracement, a 50% accuracy rate. It's going to be higher than the rest. Like the highest is going to be retracements. Your average losing trade will be low because your stop will be moderate to low. Your win rate, your dollar win, how many dollars you get per trade, will actually be moderate to relatively low. Not as low as fades, but certainly lower than retracement, or than reversals and breakouts. So if you want money and want to be a really, really, really rich person, you might not want to look at retracement trades as your core strategy. If you want to be accurate, make yourself feel good and have a psychological, I win a lot, which is mine, I'll be kind of tip my hand. That's what I want. Money is not my main motivator. It is to be accurate and to have fun. And if I'm losing money left and right, I'm not having fun, nor am I accurate, nor am I doing well as a trader, and probably I'll eventually quit. So I've made the sacrifice that this is what I want to do, to have a relatively high accuracy, have good information, good probability, but not make hand over fist money day in, day out, versus somebody who does only reversals. These are people who might get, let's say, 10 to, if you're talking big stuff, swing trades, you might get 10 to 20 trades per year that work out of, say, 40 or 50 or 60 that somehow fail. Your accuracy rate will be less than 50 probably. If you use a tight stop, your average win will be lower. You're going to have if you exit early, here's a problem. Here's a very big problem. I can pull this out. If you have if you're playing for a small target, you're going to chew yourself up. So with an early exit, you will not be able to capture the edge, essentially. In other words, low accuracy strategies need high win dollar amounts. You're going to make a lot more money per trade than someone like me that kind of does your retracement strategy, which is fine, but you're also going to have low accuracy. You're going to have to do more work There'll be more frustration. There'll be more, say, sadness, but it depends on how you tolerate it. They'll be like this. Okay, I'm done. I'm going to start reversing here. All right, no. I'm going to reverse there. All right, no. And eventually maybe you give up and say, well, screw it, I'm going somewhere else. And that's your absolute spot to get short, and there's your little victory trade. I would argue to get short over here, which is down there. So it's just, give it room to do its thing and reverse. But plus it just feels weird. It feels like trying to get short, everybody's going long. So anyway, just keep in mind, you will have a lower accuracy rate than a retracement trader, but you will have more money if you do this successfully than someone who does not. So it just kind of play off of those. The breakouts kind of combine, rinses away some of the bad stuff about reversals and adds some of the good stuff to retracements. There are fixed breakouts, which means like that triangle stuff right there, there's a fixed target. If you play fixed targets, you're going to probably find that your stress level might be a little bit lower, your workload will be lower. But to really rake in the dough year after year, you're going to have a hold on, a strategy to hold on and play what's called unlimited target breakouts. And what those are, just hold it, oh, out right there. So it's essentially how you have to play that game. Again, you probably will have less than 50%. I don't see many, I do see it. I don't see it in my trading because I don't do this very much. And when I do, I kind of get stopped out sometimes. But it's very rare to see people that have 50% plus just doing breakouts. It's not, the model would not suggest that in performance. I've not seen personally people that do phenomenally well in terms of accuracy. They may do way better than I do in terms of money per year or percentage you grow your account per year doing breakouts, but they're going to sacrifice the number of trades they have correct in a year. Correct meaning they got money or not. Anyway, you can mess this up with a tight stop. Let the market do a trap, or put the exit or the stop on the opposite side of the breakout. That's going to help you a little bit. Get some trades otherwise would have failed that would have worked out later. Versus if you do a small stop breakout strategy, in other words, if you kind of just get spooked out right over here and don't let the market go, you're not going to make it. You won't survive as a trader doing that. So breakouts necessitate big wins. You will never ever, it is not possible to get what's called a big win retracement. It is necessary and required to get not every trade, obviously, but more than your fair share of what's called big target trades. These would appear in retracements and reversals and breakouts. So if you kind of get my point here, you're basically playing the seesaw of accuracy. High accuracy is less money, or vice versa. High money tends to be less accuracy. So that is something you have to do. So read this in your own time. We just kind of talked about that. This is a summary, just kind of summarize what we talked about last week. That kind of rushed through. The best thing from a model standpoint is a retracement strategy, which is pro-trend, in a trend with high volume, which is realization, right? Playing for relatively small targets, small moderate targets, with moderate, notice I said not tight, but moderate and not wide stops. The best thing to do in terms of all the things you're going to play, and just basically mess around with this. Your targeting and your stop metrics. Retracements are pretty much bread and butter. It's not much you can do with that. How you play your targets, how you play your entries, how you play your stops, that's where you tip it to one edge or the other. And that depends on your personality. So get them outside the rinse. A rinse is basically this. It's up, down, up, oh, just getting down, up, just getting down, and then off to the races. That's what a rinse is. That's why a tight stop will nick you and will hit you and will make you miserable versus a moderate or even wider stop strategy. And yeah, small stops, actually small targets, mess that up, targets, and a wide stop to increase accuracy. That is something you can manipulate with research. That's not a bad word, but just when you start to test these things out, as I showed you a little bit, you have a strategy, build it up into a TradeStation or some other testing program, and then test out your stops and targets. You'll find that as you increase targets, your accuracy will decrease. As you increase stops, your accuracy will decrease. Vice versa. As you widen stops, your accuracy will increase. As you decrease or lessen your targets, accuracy will increase. Worst thing you can do is trying to fight a trending environment, playing a really, really big stop with a tiny target. That's going to send you to the poorhouse faster than anything you can do, even faster than being random. Random is just close your eyes, get long or short. This will send you to the poorhouse much faster, which is taking the time to find a strong trend in motion, identify a strong trend, fade the trend, go against it, and give yourself a large stop with which to fade that trend. And at the point that you're ever right, having a small target, you will go bankrupt. Trust me, not trust my experience, but from research and just logic, this is how, if you want to blow up an account really quickly and sort of do it for fun, that's how you do it. Find a really big trend, fight it, large stop, small targets. Yeah, exactly. Okay, so that's it. So 3 setups: retracements, breakouts, which will be a small target or an unlimited target, and reversals are inherently unlimited targets on that one. So all you're doing, kind of winding it down, this is what you're doing. I've given you tools. The markets are thinking, and I love games. I'm in LA, and I've kind of gotten involved in the game show, gaming community, and so it's kind of game theory, how to play out strategies and your opponents, and how to outside. It's you know, poker, that kind of stuff. So I, not surprisingly, have taken some of the insights from the gaming community and put them into the stock market. So if you do that on your own, you'll find that the markets are your world, your fixed world, things that exist inside your world, your boundaries, all that kind of stuff. You pick one of those, you begin to engage in that world. Your charts are the board. So what you're looking at, this is how you might think with like Monopoly. There's go and go to jail and whatever. That's your board that you play on. You put the rules. You determine when you enter. It's Mark Douglas, which is a great little book, Trading in the Zone. It doesn't talk about this, but it talks about how you essentially engage the market. When you enter, when you exit, it's up to you to engage it or not to engage it. So you create the rules. You set the boundaries. You get everything else. You could even create the pieces. And the indicators are the tools. How you find these things. So it's kind of a positive way to frame this stuff. It's you're creator of your own universe. You're creator of your own strategies, your own methods. And if something goes wrong, you've got to stop it. You got to find it. No one else is going to find. Well, if you work with a mentor, they'll find it. But if you work by yourself, you got to find what pieces are not working, or what rules are not working. And from that, I'll go forward. You determine. It's all about you. Empowerment. You determine what criteria you use to buy or to sell short. You determine that. I've given you lots of ways to do that. Even basic level, you can go much more advanced with them. You determine how much to buy or sell short. That's your position size. You got that. You want to double your size, triple your size. If you want to make more money, think about this. A lot of my friends run businesses. Some of my friends run businesses. To make themselves double their sales, they typically, almost always, have to hire more staff, hire or rent more space, build a different building, enter new markets, do more testing and research, create more products, To double their sales is not a simple complex, is not a simple organization or operation. They have to do a lot of work and spend a lot of money to double their sales. Do you know, if you're a successful trader, let's say you made $50,000, whatever your account size would be, $100,000 in year 1. Do you know how to double your account, how to double your profit? Click a button. If you traded 4 contracts this year consistently, trade 8 contracts next year, and oh my gosh, you doubled your business overnight. Woo! Literally, I mean, I'm not kind of being funny with it, but that's exactly how you do it. You double your business, commensurate to your account size, by doubling your contract size, or 25% increase, or whatever. Assume you keep your mind about you and your wits about you with your higher, up and down your account's going to go with your bigger size. That's how you raise your account size, is by increasing your shares and contract size, all things being equal. You are the master of the targets, small, medium, large, unlimited. You are the master of your stops, to trail them, to add a half size, to put them tight, to put them close, to use an ATR function, to use a percentage function, to use a fixed dollar, to use a point function. So on, and to use a moving average function, use an indicator function, so on and so forth. You control that. And finally, you determine how to exit. Do you exit? Do you get scared, freak out, and exit before the stop or target's hit? Maybe helps you sometimes, probably won't help you in the long term. And do you exit at the target calmly? Do you exit at the target stressfully? And maybe adjust some size if you're stressed out. But it just becomes a model of just repetitive behavior based on experience, and every single day you're going to get better. So I hope you do. Every day you're going to learn more things. And sometimes those things might be negative, as in I'm not going to do this. This behavior is not good for me. This strategy is not good for me. So I'm no longer going to be a fade trader or retracement trader or whatever you wind up being. But each day, make yourself a little bit better by communicating, by emailing other traders, talking to the traders, talking with Roman and I, talking with people that you respect and look up to, getting their feedback, getting points of view. Am I doing this right? Am I not? And what was your worst memory? What's your best memory? Just talk to other traders and keep this as a community, because you're isolated, you're cut off from the world in a sense, unless you're trading in a chat room. And so, do those kind of tips, make it social, make it fun, keep your motivation. We can learn these things all day long, but it's up to you to put them to work. If you don't put them to work, no one's going to do it for you. No one's going to sit there and trade for you. It just not the way it works. It's very empowering. It's very exciting. It's very thrilling what we do. We're very fortunate to do what we do in terms of trading the markets on a part-time or full-time basis. It's a very unique career, hobby, passion, interest, and we get to do it. So, never let that escape your mind, how wonderful this business is and how much fun it should be. It should not be stressful. It should not be frustrating. There are moments of frustration, but not every single day should be a hideous moment of, oh, I'm just stressed out all the time. So if so, go back to this model, change your world. Maybe you're trading something wrong. Maybe options aren't for you. Maybe your charts aren't giving you opportunities. Maybe the indicators aren't finding you things you should be finding. And then everything else is going to be up to you to determine what criteria from your board, from your game, and how much, where your targets go, where your stops go, and how you exit. So that's that. Email, I've already got the emails. I do love hearing from you. So email me at Corey@afraidtotrade.com. Of course, Roman is available too. Twitter at afraidtotrade.com, and Afraid to Trade, all that. So there's free website, the membership site, all that. I am here for your success. And again, thank you for attending and for paying attention. My goodness, 5 Thursdays, an hour and a half each is a lot. I applaud you for that. So thank you, thank you, thank you. I'll turn back to Roman, and I guess
Corey, yes, Corey, thank you so much. That was fascinating. And by the way, a lot of concepts which each kind of the same way. I really enjoy the concept, and I use it a lot. Getting in on a smaller time frame, and then having the higher objective on a higher time frame. I think it's a brilliant concept that we don't see that often. But you have to be really good at what you do, recognizing those spots where the reversal actually will happen for the retracement trade. But it's a very fascinating stuff. Corey, would you like to go through some of the questions if we have, or maybe some of the
there's questions. And any questions, I'll have some questions. Yeah.
Mm-hmm.
Are there questions from the traders?
Any stocks maybe you guys want to have a look, get Corey's opinion on what he thinks about those stocks? Corey, maybe you could give us a little bit of the perspective on the market.
Yes, let me go back to my little trade station here. Let's see what we got. Let's mess with Amazon. Real quick on Amazon, I was talking about that example earlier. So Amazon had its compression and had this. It's actually popped up in some of the scanners that I was looking at. It basically, again, was the number 2 compressed stock in the S&P. And uptrend, going up, higher highs, higher lows. And what happened next was this impulsive, powerful, amazing breakout here. And so that's just, it's a lesson to be had in compression, pro-trend, volume, all the metrics from that. With the actual S&P,
Corey, by the way, where would you be entering this trade on Amazon? On which
right now?
bar? Where would you put the stop loss, and maybe where would you be exiting?
Yeah, this one on the swing trade for on intraday. I kind of got some profits on this, but I didn't swing trade this one, so I was more intraday, like I was mentioning on the hourly chart. But on this one, you're going to do the break. What was unique about this one is that it bear trapped people, and that's what kind of got my attention. First off, it was on the scan, But this little metric right here, so two factors. Factor one is the uptrend in motion. Factor two is this little bar right there, that at 840. So at A, if you just look at it from a perspective of the top down, it's your typical pullback. It's nothing special. It is a pullback trade. But what made it special off the 50-period exponential average, what made it special is that the market dived down on relatively a little bit of the day, a higher initial volume to an extent, but then it reversed, slammed up, trapped those who went short who maybe didn't see that 50 period, and so they basically ran straight headlong into a wall here. And as the market reversed, gapped up, there's not a trade off of that necessarily. The trade is above 860, is right there. We're supposed to break above on higher volume, momentum starting to surge. If you go to a lower frame, we do that over here, which was that sort of right there. See, I don't know if you can, it's just something you feel. This is a feel, right? And this, I call this the finger, essentially, this right here. It's an hourly chart, sorry, 15-minute chart of Amazon. So 835 is your buy spot. And so there's your little up, down. This is a slam and reverse. So the market jumps down, gets the sellers excited, slams them out, not a trade, by the way. It's just a reaction to the market. And then when a market starts to break above these pivots, it's going to get back up. That's your second day right there. And I'm going to get my interest level on it right there, right there, right there, right there. So that's your base. It's so much more of the breakout trade. This is not something I do. So this is not something I was able to capture. But I'm not a breakout trader. So some of you are breakout traders. This is the model for a breakout. And the model would be a V-spike reversal, bear trap, going to short sell that, oops, just kidding, and a thrust back to the upside, and a subsequent high volume, high momentum. You're essentially shattering, let me get the volume up there for you, you're essentially shattering the resistance. And that is just about as good as it gets, to be honest. And that's it forecasts a much larger volume or somehow, a much larger play.
And for those of you who are Wyckoff traders, let me just quickly kind of mention a couple of points.
Yeah,
that bar that Corey was talking about below the lower boundary of the Bollinger Band, a spring, there is a difference between that bar and 3 bars before that also goes below the Bollinger Band, but there is some supply coming in before that on that big red bar. So we have to wait for the retest, and retest comes as a lower low. But still, what's interesting on the 15-minute chart about this trading range from the Wyckoff point of view is phase B. Look at the phase B testing, guys, where it happens. It happens in the upper part of the range, suggesting structural strength. So when we go into the phase C, into the sprint shakeout, there is not a lot of selling that happens a lot for the long duration. It's a very quick sell and then a quick rebound. So all of the elements of the shakeout or spring. All right.
I jumped a line even from that. So that's with Sears Holding. It's like, who wants to get long here? Is anybody going to get long here? It's going to feel hideous to get long at 865. But that's what the model says, because the next movement, and we sort of draw a little spot there, that's the breakout. High, clearly high volume, clearly highest momentum. What happened next was essentially was it 40?
Do you have the rule when, and usually, you know, I kind of want to look at the momentum on the breakout. Would you be looking at the MACD here on all of those intraday new highs, new momentum highs, and then if the breakout happens on the newer high, which we see there on the March 29th, then it's confirmation that most likely it's going to continue its movement.
Yeah. Well, on this, exactly right. So again, the market had stalled at a little kind of trading range over on the left side over here on the daily chart into March. But the momentum thing, when the market breaks, I think it was it Albert that mentioned that, it's looking at inside the market. So when you look at this in real time, again, kind of hindsight obviously, but going back to this spot, this is the highest high in momentum on the chart. It's also the highest, with the exception we kind of knocked this off the chart. It's the highest volume spike, and that's just as it starts to break through resistance. So the highest high in volume, the clear highest high in momentum, and you're sort of, there you go. You can wait for the pullback, but the problem with this is it doesn't really pull back. So it's almost one of these situations, hold your nose and get in. That's why I don't do this as a personal thing, because I can't mentally do that. But the model, the behavior, the research, the history all says if you see this stuff happen, which is a breakout from a coil, the spring, the trap, the bear trap, the break, the volume, momentum surging, you best get in. If you don't get it, you're going to miss it. And I missed it because my personality doesn't allow me to do that. But this is what you could have had, was the days up to here. And then you would exit on the reversal candle, and we walked through it, but it's your little turnabout with your divergences and such. You'd be exiting on the trend line break, basically, which would have been over at that level. So essentially you would have got, without having to do much work, really, you would have had about 864 to about 910. And so the stop would be under the trend line at that point. So that's good. It's a breakout trade, but there's little subsequent, if you don't like that, I mentioned that earlier too, I think it was Tom that mentioned that, if you don't catch the initial breakout, you've got a couple more. So if I can do this over here, yeah. If you miss the initial break, you got a little tiny retrace, a couple of retraces to go, and they're not that big. You're even better off playing breakouts, really. It's a stock, this is a stock that was just so powerful that just went on higher momentum, higher volume. This stuff was confirmed all the way till the peak over here. Then of course it went the other way.
Mm-hmm.
It's a beautiful example.
Yeah, beautiful. It's like all of the elements of the full price cycle, from accumulation to the markup, distribution, very classical buying climax there at that big bar at the end with acceleration in price, momentum, largest volume signature, and then the change of character on a sign of weakness. Yeah,
exactly. What's the breakdown from this point? Yeah,
and then it shows on the MACD as well, right? So right away you kind of see that reaction was just so unusual, so something bad about that.
Yeah, so don't buy the pullbacks. New momentum low, new volume surge. It's basically a bearish volume attack, and we're gonna cease from buying. But that makes sense because look how at that point in time, this is what the daily chart looked like. It was so many bars up. It's a reversal candle, and this, if those of you that are fade traders, this is kind of what you want to see. If you engage this, it's up from the average, multiple days up, reversal candle, and of course trend line break. And we saw the things on what Roman was talking about, your volume signature, your eventual moving average crosshair, all those little other factors, but that will be a good little spot to fade. And your target, even if it gets there, I'm not quite sure it will, but it'll be about 880 on the fade trade. So this stock may be too strong, it just keeps on going. But either way, the model suggests a pullback to about 880. It's from the Bollinger to the moving average at this point.
Mm-hmm. Okay. The market, maybe really quickly.
Yeah.
And if there are no questions, we could stop there.
Yeah, so we did our last week, our sort of our market update, and it's funny. Last time we did it was January, and so we had a directional call. It was over here. It was sideways, but we had a directional bullish call, and so the market kind of kept going sideways in January. But this time, we're having flatness. This is again the S&P. We're not seeing much. Momentum is not doing much of anything. Volume is not doing much of anything either. And our little market internals, I'll show you that real quick. Market internals are also not doing a whole lot. So we're just not that excited about the market at this point. And this is about, I don't do much work with this, but this is VOLD, volume differential at the bottom. And then this up here is of course your breadth. This is about as flat as it gets. So internals, market structure, price, it's just not giving us that much. And I hate to be that way, but there's not anything really definitive in directionality. So if we can even pull back to a larger frame, to say the 60-minute chart, you can see how these things behave in the past. So we're just at a spot right now. It's probably a distributive, probably going to be an arc bearish a little bit. But on the upside, you're starting to see this is right here. It's concentrated up. It's up, up, up. Even that's an up, up, up. But from this point, the vol is just flat as can be. Breadth is kind of hugging the midpoint at that point. Tick is compressed. We're not what I'm trying to say is we're not getting a lot of definitive signals. And so the market itself is just drifting. So we've had to drift the market really from, is that March? Yeah, from March 1st. We've just drifted. So we don't quite know what's going to happen next, and the weekly chart is going to show us a little bit more. That we probably do deserve a pullback from that. Show us a different perspective here. Make the indicators there. So you got that. So you said you got your pullback to the 20, but not, yeah. It's a sideways action, and I would say it's tantamount really to the periods that are over here. So tantamount to, let me zoom this in a little bit, to the compression zones, so which is perfectly fine. So any type of prior compression, that's about what we're having. So you look at these little things here, and then of this one, it had a deep pullback. This just kept going sideways. That had a shallow pullback. That didn't pull back at all. And right now, we're just sort of letting the market tip its hand. So it's definitely bullish, and the odds would favor a pullback than up. But we're gonna see if this thing starts to break under 23. I mean, we're gonna hit that level down there. So if this triggers under 2300, we're going to expect a down test about 2200, 22. Otherwise, we're going to keep this thing grinding sideways. So I wish I could be more directional bias for you, but if the market doesn't say that, we really can't do anything.
Yeah, that's where we are. Just consolidating, trying to get to that moving average, the one you're talking about, and with nothing we can do. We should just apply oscillating strategies. Obviously, short term, like on the intraday basis, it's a very professional market right now, so you have to be able to change your directional bias really quickly on a shorter time frame and be in and out in some cases, like in the last 2 days, or just step away, don't trade, that type of day trading market. Just concentrate on outperformance or underperformance, use the swings.
Yeah, that's exactly right. And use the if then. So it's just if the market starts to break under the moving, it's still above the 50-day moving average. That's wonderful. But if it starts to break out of that, yeah, we're going to play down. But I thought initially it was going to be sort of like a bull flag, and I'll sort of give a little hint as well. I thought it was going to be a little bull flag and keep on going up. But Wednesday got above it and then slammed it right back down. And so that was really concerning to me, that the market had the chance to break and go to new highs, and the fact that it didn't do that.
And it was such a perfect moment for it to go up.
Yeah, exactly.
It was absorbed in the last 2 days with the test, and then it was sitting right on the resistance. It was breaking out, and we were calling the uptrend and kind of continuation through the whole day, and then such a reversal of news. Such a news-driven market right now.
Fed minutes, yeah, that was the thing. The Fed's going to taper their balance sheet of $4-point-something trillion, and taper that down in the year maybe, and stop reinvesting proceeds. But also, they started calling the market overbought. So it's just words. It's just words are saying, but investors see those words and they react to them. So I don't know. I'm a little bit more cautious right now than I used to be.
Yeah, I would agree with that. Yeah. All right. Well, Corey, thank you for showing us exactly how you trade. That was very informational, very educational. I've got a lot of information from your sessions. I've got a lot of kind of like some of the new ideas, some of the same ideas that I teach, that I use in my trading, and it's just so great to hear it from you, from your experience, that you've come to the same place, you have the same type of ideas of efficiency for trading. So it was just phenomenal. And thank you so much, everybody, for coming to these sessions. We're going to have Corey back for sure. We're already discussing with Corey, maybe in August, we're going to invite Corey back to the Market Outlook session. Together with Bruce, 3 of us had just a phenomenal session a week ago about, and we had such a great feedback from you guys, so we'll definitely have Corey back. Corey, any last words?
Have fun. Keep your. We can always get more. It sounds weird, but as a trader, you can always get more money. You can make it, invest it, borrow it, whatever. Once you lose your motivation, you lose your psychological, mental capital, the game's over. So if you don't want to do this, if you no longer have fun with this, you're out. And so I think protecting your psychological capital is something more important than protecting your physical capital. That's sort of counterintuitive, but this is a mental game. It's a game. This is clearly how you engage it. It's just as easy. If people that go out of the market, they burn their account up, had they pressed the opposite button, wouldn't have done that. I know it sounds silly to say that, but let's be honest. If they would have gone long when they went short, so keep your mental capital in there. That's the biggest advice. All these rules, all these strategy indicators, they're helpful, but make your own game, create your own playing field, and keep it fun. Otherwise, you're going to burn out.
All right. Well, great message. And I think right on this high positive note, let's just say goodbyes. Guys, just a quick reminder, we are going to have all of these videos on our website for a year for you. So please make sure that you come back to those videos, you revisit those, make your notes. And definitely come back to Corey's website and to our website to see any new offerings that both of the services could have. Corey, thank you so much, and I can't wait for other events together with you.
Will do. Thank you, everyone. Thank you all for attending, and we'll see you all soon.
Thank you, guys. Bye-bye.
All right, bye-bye.